Well, if there is one company which has made the impossible look easy and has become from an unknown brand to a unforgettable franchise and more like a household name, that is Zepto. And it gives me great pleasure to bring on board Aadit Pallcha, founder and CEO of Zepto. And it's the first time I'm interacting with him, and I must say that I'm a big admirer of the franchise you've created and a very satisfied customer of the service you provide.
Thank you so much. I appreciate the kind words, and it's wonderful to be here.
You made the impossible look easy, and you came into quick commerce as not the first entrant, but at number 4 and number 5, and now you have commanding market share. I just want to understand the secret sauce, which in a sense has pole vaulted Zepto so quickly, so smartly, and so efficiently. How have you managed to do that in a market which is dominated by big boys?
So, our philosophy is very straightforward, right? This game is all about execution excellence, right? And that means both technology and ops excellence, right? I think from pretty much day one, we've, had a bend towards fiscal discipline, which doesn't mean, being, overly frugal and not investing in the business, but being very aggressive and detail oriented about the returns that we generate from any capital that we allocate towards the business and any capital we invest. So I think we've, benefited from, fiscal discipline excellence. We've gotten to, billions of dollars of scale with a fraction of the capital that all of the formats of internet over the past decade have taken, including food delivery, ride sharing, e-commerce. We've done it a lot more efficiently if you look at the cumulative capital we've spent and the scale that we've achieved. And I think, the fact that we're just singularly focused on this, I think we've got some of the best talent in internet India working at Zepto, and we just spend, 70, 80 hours a week, day in and day out, trying to crack this model in a great degree of detail, including me. I think that's what's benefited us at a very high level, but obviously can go into more specifics. But that's the secret sauce.
When you incorporated Zepto, and now we are talking about a valuation of $5 billion as per the last round, did you ever imagine that you will cross $1 billion, forget about $5 billion?
No, the honest answer is no. I mean, I think we never really started this company with the intent of starting a company. It was just Kevali and I. We had a cool idea for a project. We were two kids that loved coding growing up, and we were childhood friends, and we really had nothing to do during the pandemic, right? And we said, okay, you know what? Let's build something interesting and fun for our neighborhood. And at the time, the biggest problem was getting groceries delivered in Shahri Punjab, at least in the first wave of the pandemic. And so, we just started coding, and we started building a project, and it just kept getting feedback from customers, kept making small tweaks to the product, kept getting growth, and eventually we aligned on the dark store model, and that's when we saw real product market fit and customer love, and that's when it became a real company. So the honest answer is we never expected this. We never started with the intent of building a company or creating value. We just did it because we love building. We loved coding back then. And we find it fun to solve problems for customers, and we still do. So that's why we do what we do.
Okay. Quick commerce, many believe, is more like an urban phenomenon. It's apt for Indian cities because you save town. Indian cities have traffic that kicks in productivity and efficiency. And critics would say, Delhi or Bombay ke bahare service chalegi nahi. What are your thoughts?
So, now we've got data, right? We're now live in 25 plus cities across the country, including cities like Nasik, Rajkot, Surat, cities like obviously the Ahmedabads and Chandigarhs of the world, but even going deeper there, places like Kota, which are about to go live, places like Vellore, so on and so forth. So we've started getting into these tier 2, tier 3 cities. And you know what I'll tell you, Nikunj, interestingly enough, is that those cities are actually performing better than metro cities when we launch stores there. And the reason for that, if you look at the time for every dark store that we launch to hit 1,000 orders per day, in metro cities, it used to take 5 to 7 months. In these cities, it's taking 2 months, or now as fast as even 6 weeks. So for example, I gave, before publicly an example of Nasik. It went from 0 to 1,000 orders per day per store in 6 weeks, which a place like Bombay took 5 months to do. And the reason why that's happening is because the customers in these markets, places like Nasik, places like Kota, they don't really have great offline options, right? We're giving them, 14,000 SKUs, a lot of selection that they don't have access to. They don't have access to great service like you have in Bombay or Bangalore or Delhi. There are lots of services that exist that make your life easier. In these markets, you don't have good offline options. You've got, you've got no access to that selection. And we're able to structurally create value by vertically integrating in the supply chain and give customers, better prices as well. So better prices, better selection, better service than what they used to. So we're seeing the adoption rates actually play out better in these cities than in metro cities. That's why they're growing faster. And on top of that, you have a cost arbitrage because the rent is cheaper, the last mile and manpower is structurally less expensive. The back-end supply chain is less expensive as well. So the adoption rates are similar. The cost arbitrage is better. So I'm willing to commit even today publicly that these cities, just the cities beyond the metros, the 10th city to the 40th city will actually probably grow better and have better economics than the metro cities. Now, is that true, beyond the 40th city? I'm not sure. The density there might become too low to even offset the tailwinds that I just mentioned. But what I can tell you is that there's such a big Pareto distribution of demand just in the top 40 cities of India that we can build a very large business in just the top 40 cities without exaggeration, the tens of billions of dollars of scale. And so that's the way that I look at it. If that makes sense to contribute, but the data, it seems to be working in tier 2 cities as well, and we continue to hope that that trend maintains.
Thank you for that lovely explanation. Now, quick commerce is a space where everyone now seems to be recognizing the size of the opportunity, or as we say now in the startup world, TAM, total addressable market. Now, the total addressable market for quick commerce is large, and competition is also intensifying, both from the incumbents and also from corporates. How do you see the landscape changing at a time when everybody really wants to focus on profitability, but also gain commanding market share?
So look, from our lens, we're looking at not just market share or profitability, right? My simple thought process is that what I want to look at is, at the end of the day, return on equity. And my inputs on return on equity are, each of the stores that I'm launching, are they turning profitable faster and faster? And are they doing it with more and more capital efficiency? The answer to that is yes, right? We've proven in the past as well that stores that used to take 23 months to turn profitable are now turning profitable in 8 months. They used to take 3.5 crores of capex and operating burn to turn profitable. Now they're taking 1.5 crores, largely because of execution-led operating leverage. Things like our advertising business. We recently hit 1,000 crore revenue run rate in our advertising business. That's scaling and giving us margin leverage. Or let's say vertical integration, which gives us deeper margins. And now as we're getting more and more scale, we're commanding more negotiating leverage there. Or for example, the ops excellence tracks, right? Whether it's building better last mile utilization, better forecasting to reduce perishable wastage, vertically integrating on a fruits and vegetable supply chain, right? All of that has given us alpha, right? And that's why continue to see our stores turn profitable. And my simple philosophy here, Nikunj, is that we've proven the economics. As a 2.5-year-old company earlier this financial year, we went from zero to over $1 billion in top line in 2.5 years. And the business was getting close to EBITDA break, even with 70% of our markets fully EBITDA and free cash flow positive and turning profitable faster and faster. Once we had proven out those core economics, the philosophy was simple. If we continue to see the stores turn profitable and they're turning profitable faster and faster, but you're still burning capital because you're launching 1,000 stores, then that's a good place to be, as long as the mature stores keep turning profitable. So from my lens, I don't really look at it as growth or profitability or market share or profitability. We look at it as return on equity. As long as the stores keep turning profitable and they're turning profitable faster and faster, it makes sense to invest. And that's basically our capital allocation thinking today. Obviously, there's a lot of execution to make that a reality, but that's the way that we look at it.
But do you see a price war in the quick commerce space where the delivery charges may be artificially down? Do you see discounts and other filter levels which could be at play? Do you think that there could be a Jio-like moment in the quick commerce space?
Look, I think that I don't really see a price war playing out. I think all the players in the space are rational quality companies, right? And even just strategically, right, allocating capital to random discounts is the least efficient way to get market share, right? The bang for your buck over the long term will be very, very poor. And I think the internet ecosystem has learned that lesson the hard way over the past decade, right? So obviously investing capital, in a disciplined fashion in the right areas, let's say store launches, let's say, new category expansion, or let's say, in our case right now, we're investing hundreds of crores into Zepto Cafe, where we're investing in semi-automated coffee machines, chai monks. We're investing in blast freezers. We're investing in speed ovens to improve the core experience. Those are good places to allocate capital, and that will give you long-term compounding growth and market share, right? But bad places to invest capital is just random discounts, which will pull you back the second you take them away. And we've seen instances in quick commerce before where companies have failed because they took these poor decisions. So I don't think that we're going there. What I will say though is that at the end of the day, over the long term, what's going to matter is execution, and how you just continue to see better and better return on equity on your stores and better customer experiences. And I think that we understand that now. Obviously, again, right, you can take a call to allocate capital aggressively, not aggressively. We've taken a call to allocate capital aggressively. We think the buckets of investing capital in are high ROI. So in a nutshell, I don't think that you're going to see something as blanket as a price war, but what you will see on our end is that we are unapologetic about the fact that we're launching stores, investing aggressively, but we're disciplined about the returns that we're getting in every rupee that we invest.
Now, this is your third fundraise, which takes the valuation to about $5 billion. Are you consciously working towards taking the company public, or there could be another fundraise before you go public?
So we are consciously working towards an IPO. We've stated that ambition publicly as well. And our thought process is, although it's difficult to comment candidly, and the fundraisers are a function of when capital is available and what price, and from is it available from high quality partners or not. So it's difficult to comment what we would do before the IPO, but presumably we do a pre-IPO and then we do an IPO is the most likely scenario. But yeah, the ambition would be to go public relatively soon, hopefully sometime next year is our thinking. But again, we'll see. There are lots of factors that might change between now and then.
Looks at the pure cash burn, and I do have the data, source-based data, which compares your cash burn with, let's say, some of your peers. Your cash burn levels are high. How would you justify that?
Yeah, so like I mentioned, I think like right now nobody really has our numbers per se, right? Because we're a private company. But I think to give you a sense, we are. So last 7 months ago, we put out a note publicly that we were at 1 billion in GMV. At that point, we had spent a fraction of the capital that both our competitors had spent cumulatively to get to that scale, right? And we had the data to prove that, which is why we were able to raise the $1 billion of capital that we did. And then after that, we took that call, which basically was, like I mentioned, right? Your stores are turning profitable. They're turning profitable faster and faster. You're a 2.5-year-old company with this huge opportunity ahead of you, and you've proven the ability to execute. Now is actually the time to accelerate, right? And it's not the time. If you're close to EBITDA positive in 2.5 years, you've scaled to $1 billion. The business model is working. Why would you slow down today in year 2.5? You should actually go in and invest, right? And I think that's the simple thought process, and we're seeing the returns on that investment, right? So 7 months ago, when we said we hit $1 billion of top line, today pretty soon we're going to announce another big milestone, which will be we're going to announce within this year that we hit 3 billion in 7 to 8 months. So from 1 billion to 3 billion in GMV in the span of 7-8 months, with in cumulative terms a relatively small amount of capital invested, and we'll continue to compound that, and we'll continue to multiply on a scale of billions of dollars. So to give you a sense, Nikunj, how to justify that, as long as the stores keep running profitable faster and faster, you're in a good place. And are you seeing the returns in the growth? And clearly we are, right? We were at $1 billion in GMV 7-8 months ago. Today, pretty imminently, we're going to hit 3 billion in the 200% growth in the span of 7-8 months, which I think is pretty incredible. And in cumulative terms, a relatively small amount of capital spent. Even if you benchmark us to our direct competitors, you benchmark us to food delivery, you benchmark us to ride sharing, you benchmark us to e-commerce. I think we've proven that alpha, and we're seeing the mature stores continue to turn profitable. So that's what matters to us.
The backlash for quick commerce could be it is impacting kirana stores, the mom and pop stores. Are you eating into their market, or are you simply expanding this market?
I think it's a fantastic question. And look, there was a CAIT report that said that we were taking share from kirana stores, and there was a letter also written by an association saying that we were taking share from kirana stores. And Nikunj, just to give you some background, right? Since the day that we started this company, there have been inaccurate, misleading narratives about quick commerce, right? It started with nobody wants 10-minute delivery or 10-minute delivery skilling delivery drivers, which we disproved with data, right? That it's actually safer than other formats of e-commerce because most of our deliveries are intra-neighborhood, not on highways or freeways, or the economics will never work for 10-minute delivery, right? This is just another inaccurate narrative that, oh, quick commerce is hurting the kirana store. Let me give you the data, right? In the same CAIT report that wrote that we were replacing the kirana store, they quoted a research study by Datum Intelligence. And that research study said that quick commerce has taken $1.2 billion of sales from kirana stores. Now, that same research study, if you look at page 6, says that between FY23 to FY24, and this is a consensus view, not just in this research study, but this is across multiple studies, the same research study in page 6 said that grocery consumption in India has grown by 46 billion from FY23 to FY24. Right? So if quick commerce in their own report has taken 1 billion, but grocery consumption has grown by 46 billion, in their own report, it's mathematically impossible that the kirana store would be shrinking. It's not possible. Right? Obviously, we're growing, but the kirana store, the remaining 45 billion, where did it go to? Where did the kirana store? So the kirana store is also growing, right? You can see it in their own data, right? You've got $45 billion there. To make the argument that the kirana store is shrinking is ridiculous because the economy is growing. At least it has grown 7%. We're expecting consumption to continue to grow. The kirana store, we're expecting from FY24 to FY28. If you look at the Goldman Sachs consumption report, you look at Invest India, you look at the Datum Intelligence report, the consensus view across multiple credible reports is that between FY24 and FY28, Indian grocery consumption is going to add between 200 to 250 billion. That's a consensus view, right, across all credible research studies. And that 200 to 250 billion, today quick commerce is 5 billion. Even if we grow 1,500% in the next 4 to 5 years, which would be insane, even if we grow 1,500% and we get to 75, 90 billion, we are less than half of the incremental 200 to 250 billion dollars of consumption that's getting generated. So where is that additional 100 billion going? It's going to the kirana store. So the fact that people are saying the kirana store is shrinking in the fastest growing G20 economy in the world, it's just hyperbole. You can go down the road, you can interview someone, you can ask leading questions, and you can create false narratives. Just when people said nobody wants 10-minute delivery, if I asked you 3 years ago, do you want 10-minute delivery? You'd say no. So you can create narratives, but the data itself, even their own data, doesn't prove it right at scale. But what I will point out, Nikunj, is that not only are we just a small, not only are we, even if we become very big, the incremental consumption growth, not only does that contribute to the kirana store's growth, but we're also in this position where we're actually a net job creator. In the past 36 months, our estimate, this industry has created 450,000 jobs, and we can give the data and the backup for that. In fact, there was a report that said 400,000 jobs have been created, from team lease by quick commerce in just the first 36 months. And these are, net job accretive with better wages than what the people were making before they came into the system. If you look at the surveys that we've done, a young male between his 20 to 30s with no formal history of employment and no formal college education or 10th or 12th pass. That's the median Zepto delivery partner, Zepto packer, Zepto truck driver. That's what the median profile looks like. The wages that they were making before they came into a Zepto or a Zomato or a Swiggy, that gig work ecosystem, we estimate between 10 to 15,000. They were engaged in some form of, informal employment. After they come into a Zepto or a Zomato or Swiggy, the amount that they're making is 23,200 rupees. And it's net job accretive. Most of that's, by the way, the people that I'm talking about that were employed. The biggest chunk of those people before they got into gig work were unemployed, right? And so we've created, hundreds of thousands of jobs, 4.5 lakh jobs in 36 months. It's wage accretive. It's 23,200 rupees on average, which is 30 to 40% higher than what even the employed folks were making before they came to our platform. So we're wage accretive. And most importantly, we're growing. In the next 2 to 3 years, just imagine 4.5 lakh jobs created in 36 months. We're expanding rapidly. In the past quarter alone, Zepto alone has added 25,000 jobs, and our peers will add the same, I'm sure, at similar rates, right? in the next, realistically, 2 to 3 years, we will cross like 1.5, 2 million jobs. Today, at least the current data that I've seen is that Indian Railways employs between 1.2 to 1.4 million people. Will create more jobs than Indian Railways. And I think we should celebrate that. This is way too creative. This is a net job creator, and it's part of expanding consumption. And the own data of the people that are making these allegations against us prove my point. So again, right, so we like data, we like facts, we don't like anecdotal, subjective narratives. We've been through these things before since we started the company, right? And so far, all of them have been disproven with data and facts, and that's the way that we like doing it.
So from 1 billion to 3 billion is what you've told us. 5 billion is coming soon. When will you reach 10 billion? Will it be before the turn of the century? Turn of End of the decade, sorry.
Maybe I'll be around turn of the century, but I will. I can't obviously comment on when we would get there. But look, I think we're expanding on and multiplying on a base of billions of dollars. We're doing it in a capital efficient manner. We're seeing the mature stores continue to turn profitable even faster than the hundreds of stores that we've turned profitable in the past. So we feel good about making upfront investments today to set up our business for scale and success next year and the year after that. So the last thing that I'll mention, Nikunj, is that if you look at internet globally, right, whether it's Uber or Airbnb or Coupang or Mercado Libre or Nubank or even the Chinese companies like Meituan and Pinduoduo, all of them invested billions of dollars. They burnt billions of dollars. Initially, people thought they were jokers, that this doesn't work. But the reality is they were executing deeply even while they were investing capital. And today, all of those companies generate billions of dollars of free cash flow. All of those companies generate billions of dollars of free cash flow today, right? Like if you look at Uber as a classic example, $15 billion of capital burnt. Today, I believe they're generating about $6 billion of free cash flow. Meituan is another example. Nubank is another example. Coupang is another example. Billions of dollars burnt, now generating billions of dollars of free cash flow. That is a legitimate framework. Even Bharti Airtel is another example of that framework. So investing capital in a disciplined fashion, as long as you can see the profitability, is a good thing to do. And it will set us up to generate meaningful amounts of cash flow in the long term. And that's the mantra at Zepto, right? It's all about long-term free cash flow to the firm per share. And we think, 2026, 2027, we could be generating not a small amount of cash flow, but a huge amount of cash flow, that could be benchmarked to, internet companies globally. And I think the framework that we're implementing is the right framework.
I've just got a couple of more questions for you. I'll shamelessly take the liberty of extending my appointment with you. I know it's middle of a working day for you.
No problem.
My next question is that in terms of categories, which are the real high growth categories for Zepto? And do you see evolution of more and more categories getting added in quick commerce? I mean, 3 years ago, to imagine that you can actually order an iPhone or air conditioners on quick commerce platform was impossible to fathom. But now it's a reality. And I know folks who are ordering it. So which is the fastest growing category for you? And in how many new categories are you likely to expand also going further?
Yeah, absolutely. So look, I think the fastest growing category for us right now is cafe, right? Zepto Cafe. I mean, obviously multiple categories are growing fast, but I'll give you cafe as an example for right now. We've got coffee, tea, snacks, samosas, brownies, cheesecakes. We've got, even things like, biryani and bhel puri delivered in 10 minutes with a mini cloud kitchen within our dark stores. And in just about 15% of our dark stores, it's already doing 160 crores of revenue. Just in 15% of the dark stores that we currently have and we plan to launch by next quarter, it's already doing 160 crores of top line. And, the profitability of this category is meaningful. The margin that we're talking about is 55 to 60% on food that we're making today in our dark stores. And the beauty of that is, we think if we scale it from 15% of our contemplated dark stores to 100%, we could easily take this to 1,000 crore revenue business just by scaling it in all of our dark stores over the next 12 months, right? And so that's exactly what we're doing. We're now, today as we speak, launching 140 cafes per month. We think we'll realistically hit 1,000 crores of top line in Zepto Cafe by next year. And customers love it. I mean, I'd invite you to just go on Twitter, search Zepto Cafe. You'll see a lot of love for the Vietnamese cold coffees. You'll see a lot of love for the brownies. You'll see a lot of love for, even the samosas we're able to deliver in 10 minutes. You're getting your Ashirwad atta, you pick up a samosa and a coffee while you're doing that. It's a beautiful experience. So customers love it. It's giving us frequency and retention goodness. It's net profitability accretive. And it's one of the biggest investments we're making today. And so that also, I think, is a high quality investment. There's CapEx, it's CapEx intensive. You've got to get coffee machines, chillers, you've got to get chai monks, you've got to get even things like speed ovens and grillers. But those investments are today, at least when we look at the paybacks for the cafes that we already have, they're pretty healthy. Like the payback on the cash that we're deploying, and we think that as we scale, we'll get even more leverage on it. So Zepto cafes, I think that the category that we're most excited about right now. And obviously, the rest of the categories that we're talking about, like electronics, general merchandise, beauty and cosmetics, apparel, they're also growing. I mean, they've gone from effectively zero at the beginning of the year to today they're doing like over 100 crores a month of top line in those new categories. So, and that's again already well over 1,000 crores of top line in all these categories: toys, books, everything else we're scaling. So you're going to see assortment expand meaningfully. But cafe is one of the biggest ones that's really giving us a lot of leverage.
My last question is that if I draw parallels here, Swiggy has incubated businesses from food delivery to moving to quick commerce, and they incubated the business. Zomato has acquired businesses. They acquired Blinkit and now they've acquired the events business of Paytm. What would be the path of growth for Zepto? Would you be incubating new businesses and make one super app, or you are also open to big acquisitions as you grow, as you generate more cash, as you want to experiment more?
So, we've never been an acquisitive company. We are very much focused on organic execution. And I doubt that we're going to change that DNA, right? So my personal philosophy, I'm not a big fan of M&As. I think, it just adds, complexity and risk. And, obviously it's all about price, right? I think, Zomato's done an exceptional job managing the acquisition that they pulled off, right? Kudos to that execution. But I think we're generally, we believe in organic execution, organic growth. We're not a very acquisitive company. What I will say though is that we don't want to launch new businesses. Like we are 100% all in on quick commerce. Everything that we do is within the quick commerce flywheel. Everything, whether it's Zepto Cafe, whether it's electronics, whether it's what we launched just recently with Super Saver, all of it is within the core quick commerce flywheel. That is where 100% of our time and energy is going into, at least for the next decade. So, what I'd tell your viewers is don't expect us to launch new businesses, right? We will not get into thing like food delivery, for example, or any other type of consumer internet business. We're all in on quick commerce for the next couple of decades, and we're obsessed with it. We think it's a once in a generation opportunity to build a world-class internet company in India. And the last thing that I'll say, Nikunj, is that whether it's us, whether it's Zomato, whether it's Swiggy, we should be proud of the fact that this is Indian innovation. Quick commerce is an Indian phenomenon. It's been built with Indian technologies by Indian entrepreneurs. It's making everyday people's lives better, right? We're giving a better service and better prices with real structural supply chain leverage. And today, for example, there's a mom, probably in Noida, for example, that has got 3 kids and is now able to take a part-time job because quick commerce has made her life much easier, right? And that's something that we should celebrate. It's like a metro station. It's like a bullet train, but only in India. Only in India can you actually tap a button on your phone and your day-to-day essentials will come to you in 10 minutes. I think that's world-class infrastructure and world-class Indian innovation, and we should celebrate it. But most importantly, that world-class innovation is creating, hundreds of thousands of jobs and will create millions of jobs. Already created hundreds of thousands of jobs in 36 months. Is adding, value to people in the form of wages. Quick commerce as an industry also in the next 3 years will contribute $1 billion of tax in just direct tax, not indirect tax, just direct tax, $1 billion of tax to the Indian government, and we're going to keep expanding. Right? It's great. It's value for the entire ecosystem, and we're proud of that Indian innovation. That's what keeps us going. Let's build a company that this country can be proud of over the long term.
I am, like I said, I'm absolutely amazed with what was unknown has now become an unforgettable franchise. But I'm tempted to just throw in one more last question, which is that What about all the attention which you're getting from media? Some call you the Wonder Boy, some say you're the youngest billionaire, the boy who saw tomorrow. How do you deal with so much of attention? Do you like being definition of being called as one of India's youngest billionaire, the Wonder Boy, the man who shook the quick commerce industry? How do you deal with all this?
No, I mean, very candidly, and I'm sure the cynics, the cynics will find this difficult to believe, and I understand that. But really, honestly, like Kevin and I couldn't care less. Like we are just here in the office, right, and we're trying to build something really exciting and valuable for consumers and for this country and for shareholders. So we don't really pay much attention to it, right? My life hasn't changed much. We still wear like regular clothes, regular track pants, right? We're not sitting here buying crazy cars or flying first class, right? We're not really interested in these things. We put the benefit of youth on our side, and I think what excites us a lot more than things that are superficial, like money and attention, is really building cool things, cool technology, and real value. And that's at least what I want to do for the next couple of decades. So yeah. So all good. I think it's the attention can be good and bad. The attention is inevitable, though, like you pointed out, right? If we're going to build to this scale, we are going to end up getting attention. So we have no real other option than to own the PR, and we are trying to do a good job with it. At least be authentic with our message, and hopefully it lands well. But yeah, that's all we have.
So nice to talk to you. All I can say is that vision, passion, dedication, hard work, frugality, commitment. If I have to summarize the ethos of Zepto based on our today's interaction, I can really put these words together to present what a wonderful franchise you built up. Good luck and wonderful talking to you.
I really appreciate it. Thank you so much.
If you like this video, then like, share and subscribe to ET Now.